Welcome to TheoTrade. This is Don Kaufman. February 13th, 2021. Doing the TheoTrade weekend update here on a Saturday morning. When the bonds break, that's going to be one of the key topics of conversation in this weekend's update. Now listen, not everybody necessarily looks at the bond market, but you're going to want to, as the yield curve, it's getting steep, people, and it could very well be a key inflection point. That is, the bonds can be a key inflection point back into the S&P 500. We'll look at that in just a few minutes. Before we get there, let's actually break down the markets and some of the trade we saw in this past week. Markets, well, they stagnated. I mean, take a look at some of the previous weeks of trade. And I'll actually highlight a few things for you. What you're looking at right now happens to be none other than the SPX, the mother of all products. But the SPX kind of illuminates this well. And again, the hash marks on the screen, of course, are expected moves. This is what the options marketplace depicted risk to be. And again, I'm back here 3 weeks because 3 weeks ago we smashed the bottom edge of the expected move. Then, of course, the wicked rally, we smashed the upside of the expected move. This week, we completely stagnate. And when I say we stagnate, you're like, well, we kind of trickle to the upside. Listen, this week, we had a $63 expected move, right? So what I'm actually referencing is this past week of trades, he's a $63, expected move. It means, you're supposed to move $63 higher, $63 lower. You realize the previous week of trade, just the previous week of trade, you were coming off of a 170-point actual move in the S&Ps. The previous week was also, again, kind of a couple of wicked weeks. So, what do you say about a week where the volatility completely died out? In fact, we're going to look at that because there's a bit of a catch-22 saying that the volatility died out, which you're going to see in a moment here, because I'm also going to talk a little bit about inverted implied volatility skews. This is going to get a little bit deep. I like it. Again, there's some good trading opportunities in here. So to begin with, as I said, this week we kind of stagnated a little bit. So the S&Ps, they started the week here at 38, we'll call it 90. We trickled to the upside to 39, 37 inside of the SPX, and that is nothing more than a trickle. I mean, there was a lot of days in some of the recent volatility that we moved more than we did in the entire week. And I got to tell you, the S&P futures, just look at some of the intraday trade from Friday. We did absolutely nothing. We were quite literally massively unchanged throughout the entire trading session in the marketplace. For the most part, this is a little bit of gamma risk being covered, and we just floated to the upside. I wouldn't be surprised to see this pull right back into this, and I'll get really specific here. I wouldn't be surprised to see us pull back right into like the 39.11, 39.10 handle when markets do reopen. And kind of a reminder to you, yes, the futures will open on Sunday, but Monday happens to be a holiday. Of course, in the U.S., and the U.S. equity marketplace will be closed. So the next time we'll be trading equities and equity options will not be till, of course, Tuesday. And that would be Tuesday, the 16th of February. Just wanted to, key everybody into that. All right. So as I was saying, the market's kind of stagnated, but as partially true. All right. The QQQ, which is, of course, the representative of the NASDAQ 100. It also kind of stagnated throughout the course of the trading week. Again, if you took a look at trade on Friday, there was absolutely nothing, a little bit of a bid. The only marketplace that really gained some ground and things got just downright sketchy this week was the IWM, the Russell. The Russell actually caught a bid again, but it closed inside of the edge of the expected move. In fact, it closed on the edge of the expected move. This has been one of the most wild marketplaces that anybody's seen. I mean, and it's, this is something that we're taking a lot of positions in right now. Again, on a year-to-date basis, you're up about 17.5% in the in some of the small caps over there. So, talk a little bit about a gamma squeeze and so forth. There's a whole lot of gamma in here. All right, we'll come back to that though, possibly when we talk a little bit about an inversion. All right, one of the things I said, it's a bit of a catch-22. Volatility contracted in this week of trade. In fact, when you start opening up a 1 year, and we're looking at the VIX, and for those of you that know this, I'm not a huge advocate of the VIX. I'm just not a huge advocate of the VIX because I don't think it does a wonderful job in kind of portraying what risk really is in terms of overall volatility. But you take a look at this. We are effectively at the lowest point in terms of the 30-day implied volatility in the SPX, right? I mean, that's what the VIX really measures. It's it's 30-day implied volatility in the SPX. This is the lowest point since the onset, pretty much, of the Corona crash from last March, and it's critical to see this because there are huge positions being taken right now by retail traders inside of some of the volatility products. Now, this is a really critical kind of juncture to understand. Again, and I want to clarify exactly what people are doing. Retail traders are coming in and they're buying volatility right now in massive amounts. They're getting long volatility. So the assumption is that the retail world believes that volatility is going to go up. And that unto itself could, in fact, actually cause volatility to rise. I mean, do we need to start talking about GameStop again? Probably not. But the impact of this, okay, and it's an interesting impact because it's being felt in the volatility futures. And again, there's so many people that trade volatility products that just have absolutely unequivocally no understanding of volatility products. Volatility products, I'm going to tell you right now, after 20 plus years of experience in this business, the volatility contracts, and I know that some of you are thinking, nah, I don't trade volatility contracts. I trade VXX. I trade UVXY. Yes, these products are designed, okay, out of the volatility contracts themselves. I mean, they're designed and they're based on volatility futures. But there's what they call contango and there's what they call backwardation. What I want to explain to you is look at like the 32-day. These are 32-day volatility contracts. Let's say that they're trading for 26. I'm just rounding. The next contract out is trading for 28. It's huge, man. Huge. The disparage between, the 32-day and the 67-day. And what's going to happen is your VXX contract is based here, and eventually they have to sell this and then turn around and buy this. And what that is doing, okay, when they're selling the shorter term contract to buy the next contract, look at the 4 days. I just want you to see this right now because the 4-day, okay, volatility contracts all the way down to 21. I've been doing this a long time. I have not seen, okay, any period of time where there was this much differential between like 4-day, 32-day, like 46-day. Again, I don't want to go geek out on everybody and talk about like, contango, but for all intents and purpose, this is retail client trade. And what's going on is, again, these big firms that create stuff like VXX, and I'll come over to the VXX for a second. The big firms that create stuff like VXX, they use trading firms, and those trading firms will actually go out. They're having to sell the short duration and buy further duration out, and it's going to crush this product. And you're like, what do you mean it's going to crush the product? Okay. Well, a moment ago when I showed you the 26 versus the 28, and again, to kind of illuminate this a little bit, when you roll the contract from 26 to 28, somebody has to pay for that $2. You know who has to pay for it? Yeah, you. Okay. If you're long the VXX is going to have, okay, absolutely immense amount of what is termed drag. If you've never heard the term drag, okay, let's call it really what it is. It's almost like an option decaying. So the product itself, the VXX, and people of course will email me after this and go, no, they fixed that problem. No, they didn't. Okay, they just made it a little bit more mild. But the VXX has decay. In fact, the VXX is actually part B, and the reason it's when I say it's part B, look, it's the iPath part B because A eventually they had to reverse split it enough times because there's drag on it, right? They reverse split it like 4 for 1. They reverse split it 4 for 1. When I say reverse split it, it'll come down to 10. They'll reverse split it, then it'll be 40, right? Reverse split, basically, they take, if you had, 40 million shares, they'll reverse split it, and there'll only be 10 million shares, and, they adjust the price back up, and it'll happen time and again. Be extraordinarily careful if you're trying to get long in something like VXX. The only way to be able to effectively do it would be use some type of spread. I would maybe buy a call spread and, have a little hope on there. But getting long the physical VXX is it's a death wish at this point. And I don't mind saying that in any way, shape, or form. Read some of the prospectus, and it'll even tell you, don't hold this product overnight or you're going to die trying. With that, so volatility contracts. And I went on a little tangent on there because over the years, again, my years at Thinkorswim and TD Ameritrade, I've been involved in a lot of issues involving, products like some of these volatility products and people holding them literally for months and for years. You lose everything in them. So the volatility contracts to near its lowest point. But the interesting thing is about volatility contracting is more people are getting long in volatility. So people are buying volatility and volatility continues to contract. But here's something interesting, because the professional world believes the exact opposite. Professional world this week was actually on the bid in volatility of volatility. What I'm saying is, if you look at the VIX itself, the VIX might be contracting. I said it's a little bit of a catch-22. Although the VIX is contracting, the options in the VIX are actually going up in price. Why? Oh, yeah, a lot of professionals are actually taking volatility positions. What are the professionals doing? Well, for the most part, to create volatility to go up on the VIX, they're probably buying calls. That's really the only way to get volatility to go up is, for the most part, to be a net buyer of calls inside of the VIX. A whole lot of call buyers in the VIX, and they blanked it out over here, but a whole lot of call buyers in the VIX, though, and that is actually driving volatility a little bit higher. So when you're looking at markets stagnating and you're looking, volatility is getting crushed, it's not. Okay, volatility getting crushed is actually like an artifact of people going out there and buying stuff like the VXX. But the reality is professionals are predominantly buying volatility right now. Now, let's actually move on. This is another huge topic of conversation in this weekend's update. The inverted skew in the marketplace. Inverted skew in the market. So what an implied volatility skew happens to be. Let's actually cruise over to the spiders for a second. Let's just open up an option chain. Let's open up an option chain that's some 30 days out. Okay, and I've got every single option in the chain open. A very normalized implied volatility skew in most index products, and this is an index product, right? The at-the-money implied volatility here is 16%. And that 16%, what it does is it kind of prices this option. You look at the option, you go, it's $7.20. I look at the option, go, it's 16.25 vol. And the further you go out of the money, okay, the volatility, the implied volatility actually drops down to like 13%. All right. So that is a very normalized skew. And then that's on calls. If you looked at puts, the opposite is true. Okay. If you looked at puts, the at-the-money puts are trading for 16, but the further you go out of the money, okay, the volatility rises, right? Oh, yeah, look at those out-of-the-money puts trading for like 23, 24 vol. And the reason that occurs is because the market's predominantly, if they're going to crash, the risk is to the downside. So with the risk to the downside, everybody's like, I'm going to buy puts. How do you buy puts? You buy puts and you finance it by selling calls. And that actually kind of tweaks the implied volatility of a major index product. But then we come on to something like Amazon and Tesla, right? So if you take a look at, Tesla is so, it's becoming cliche at this point. But there's so many things I could point out inside of Tesla when I say it's a little bit cliche. Let's go a little further out in time and explain this in quite some detail here. But if you take a look at the at-the-money implied volatility of the calls inside of Tesla, 64, 65%. And then it dips down a little bit, but then it starts to rise again. And what you basically have is implied volatility kind of goes like this. It goes down a little bit, and then it actually rips, the further you go out of the money on the call side. So take a look at some of these out of the money calls. I mean, they're all the way up to like, 72, 73. So this marketplace in light of whatever you might think, it doesn't matter what you think. It matters how it's priced, right? The out-of-the-money calls are actually trading in a lot of cases for as much, if not more, than the out-of-the-money puts. So this is a marketplace that's literally like pricing a crash to the upside. And I think that this is a grave mistake on the part of the marketplace. And it's, am I saying the marketplace is wrong? It's always a difficult thing as a trader to say the marketplace is wrong because, I grew up in efficient market, hypothesis, and I can go on and on and on about this for days. But I will tell you this, for right now, and I'm going to tell you my exact belief over here. For right now, unequivocally, I think the marketplace is right. There is a lot of risk to the upside. There's gamma squeeze and so forth. But I think in hindsight, we're going to look back and go, wow, this was incredibly stupid decision on the market's behalf, because it's not like the out-of-the-money puts are necessarily trading cheap, but they're not pricing the same mechanisms that are driving markets higher. I don't feel like we're pricing that same mechanism for the drop lower, because a gamma squeeze doesn't mean anything in terms of directional bias. The same thing that squeezes to the upside is eventually going to squeeze us to the downside. And if you look back historically, the gamma squeeze to the downside is inordinately violent versus the upside. So I think that the markets are doing a poor job of handicapping risk to the downside. And with that, I am more apt to want to sell premium. I mean, you look at something like Tesla. And again, I'm just going to go way out in time in Tesla, just make a quick point. Look at some of these. I mean, this is a 62 days out. And again, I'm not here to pitch selling premium in this, but you look like some 62 days out. It's like 83% implied volatility. Okay, that's the 1700 strike. I mean, Tesla, what does it have to do? Oh, double. In the next 62 days, is the stock going to double? Or you get paid basically $2.50. I'll take the $2.50. I mean, listen, I'm talking about, markets right now, like Tesla, it's stagnated for a while. I mean, the entire marketplace, as I was saying a moment ago, stagnated. This is a good time, especially with Skew. It's a really good time to be positive theta. That's what I am right now. I'm positive theta. I've been creating the Theo theta portfolio. I've been selling premium, been positive theta. But I just wanted to point something out, like in Tesla, that's, it's an anomaly. Yeah, it's a huge anomaly. And, the marketplace, the market's never wrong. Except, you know what? The marketplace is just a reflection of what retail traders are doing. And retail traders, apparently, they're going out there and just buying loads and loads of calls, and they're actually driving the implied volatility up. And there are market makers selling all this out of the money premium. Yeah, I'm getting into that business too. So I'll be selling the out of the money premium. And I also brought up Amazon, because Amazon isn't necessarily like a cliche. But when you start looking at stuff like Amazon, and again, I want you to be objective for a second. I'm going to go literally 97 days out, because I just needed to point this out because it really, really resonated with me. This is a $3,200 product. Okay, check this out. The 5,000 strike calls. I know they're 100 days out. I don't care. They're trading for like $7. It's insane. And again, the amount of implied volatility out there is insane. So with this, what it's actually doing, some of these skews, okay, it's making, and again, specifically in anything that has this skew, and you can look at stuff like, look at stuff like NVIDIA. Okay, if you wanted to get bullish in something like NVIDIA, with all due respect, I don't care whether you want to get bullish or bearish. Okay, but if you want to get bullish in something like NVIDIA, okay, turn around, like buy a call spread, buy like an out of the money call spread, and I'll tell you exactly why. Okay, in the out of the money call spread that you'd be buying, right? If you wanted to get long, you buy the out of the money call spread because the skew is with you. You're buying like a 50 vol and selling like a 51 vol, right? Skew is actually in your favor in that one. If you wanted to sell something, okay, if you want to sell something like NVIDIA, all right, you got to go way out of the money. You probably have to sell and sell naked because the skew is just huge out here. So there's actually a reason to be both a buyer and a seller in something like NVIDIA. So I'm actually doing a combination of the two, which I'll actually show a little bit of this week live on TheoTrade, where I'm actually buying inside premium and selling massive amounts of outside premium. And that's something I was also discussing a little bit last week. The other aspect in here, if you look at something like put spreads in a product like the QQQ, if you said to me, hey, I think the Qs are going to crash and burn, okay, buy put spreads in them, okay? Take a look at the put spreads are actually trading cheap relative to the call spreads. And I'll just go out to like a 35 delta option. Here's a 328, okay, 318 spread. Look at this. This is a $10 wide put spread. $10 wide put spread. That is what? It's a couple bucks out of the money, but neither here nor there. It's trading for $2. If you looked at almost an equidistant out of the money, call spread. And I'll just go, I can go by delta over here, but again, about equidistant out of the money. We'll go to the 344, 354. This one's trading for 317. The call spreads are trading for, $1 and change more. Why? Okay. Oh, because the market's pricing the upside. right? But think about that for a second. If you need a downside hedge, there's your downside hedge over there. Again, put spreads are trading low relative to call spreads in index products. And again, if you want to get bullish in a lot of major products out there, I said if you want to get bullish in stuff with inverted implied volatility skews, NVIDIA, the Facebooks and Netflix, buy out of the money call spreads. Those call spreads are going to protect you. All right, last but definitely not least, okay? This doesn't require a huge, amount of discussion over here. But when the bonds break, I mean, you got to understand at this point in the marketplace, okay, the bonds, there's a huge amount of trade going on inside of the bond product, and the volume it's just absolutely, it's massive. Okay, and massive bond volume has a lot to do with a Volcker rule that was put in place years ago. The banks, okay, are taking huge directional positions in the bond product, but the banks can't necessarily take directional positions inside of stuff like the S&Ps, which it's a much longer discussion. But the bonds have actually broken down, and with the bonds starting to break down, if you take a look at the TNX, this is the interest rate associated. Open up like a 1 year, okay? So where we came from, again, the onset of Corona. Okay, we were up here, 1.6. By the way, that's about 1.6%. By the March lows of the S&Ps, I mean, we're actually trading literally like 0.39%. This is on the 10-year. From 0.39%, literally in just about a year, we've actually come all the way back now to 1.2%. And it's becoming a little bit alarming because at some point, and again, I'm going to go a lot deeper into this, but at some point, rising interest rates can really, really help the financials. Like a rise in interest rates helps the financials. But when the interest rates start to explode higher, it'll actually have an inflection point. It'll actually break the back of some of the financials out there. And that is something to seriously consider at this point in time. And when I talk about this, without going into like just wild detail, I'm actually going to bring up a yield curve. And not too many people are familiar with this. This is the U.S. Department of Treasury site. I know it's a very exciting website run by Janet Yellen now. Huh? There you go. Yellenator is back. But the thing I wanted to point out about this, and I'm just gonna highlight a couple things for you really quick, right? What we're gonna look at, albeit briefly, is here happens to be the 10-year, okay, and here's a 30-year. Now that was back in the beginning of February, and here is of course right now. And what you're looking at is the interest rate associated with the 10-year. Okay, it's 1.09%, and it's over in the 30-year it's 1.84%. You're like, okay, I get it. So what's the differentiation? And they're just round. It's like 0.7%. Then you look out here, just a few trading days later, you're like, okay, this is now 1.2%, and this is 2%. You're like, well, what's the differential in there? 0.8%. What you're actually looking at right now is what they call the steepening of the yield curve. All right, so the yield curve might look something like this. Now the yield curve looks a little bit more like this. The differential between the 10-year and the 30-year is growing, and it's growing really, by the way, this is a huge move. You're like, it's 0.1%, guy. That's huge. It's absolutely huge, and it's fast. And all I want you to recognize is that that yield curve, all right, can actually set off a chain of events, and the steepening of the yield curve, can set off a massive chain of events. I would watch this very, very carefully because I think we're very close to an inflection point, very close to the bonds kind of breaking back of the S&Ps. It's going to take a little bit more sell-side activity, but moreover, it's one of the reasons I believe that a lot of professionals are out there buying volatility inside of the volatility product itself. Because again, you got to remember something, that the professional side of trade is limited. Professional trade is limited, okay, as to what they can do in the S&Ps. If you're a major bank, you can't go out there and take huge positions in the S&Ps. You can't take huge positions in equities. But the banks absolutely, unequivocally are taking huge positions inside of where? The bond product, okay? So they're turning around and they see the bonds breaking to the downside. Watch stuff like the VVIX because the professionals will also step in and they will use volatility products to mitigate a degree of risk, especially if the bonds are going to break. They know that the S&Ps are going to break. So without taking like quote unquote directional positions, these professional firms are actually using volatility products in effect to take directional positions in the marketplace. They're kind of going to like a tertiary marketplace to do so. So if you take a look at this, people are going to ask me, of course, where do I think that the inflection point is? I think we're sitting right on top of it. I think we start to break through 165. Again, I think we start to break through 165 inside of the ZB. It could very well be a turning point inside of the S&P 500. Again, this next week of trade, it's a 4-day trading week. We only have a $57 expected move. So we're expecting, okay, on a 4-day trading week, a little bit of lower vol. I'm still of the belief that we're going to see, okay, volatility start to break back to the upside again, and in a very, very short term over here. That's it for this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful 3-day weekend. Bye-bye.